1. Master one strategy before moving on. When I first entered the world of trading, the sheer number of strategies out there was overwhelming. Scalping, day trading, swing trading, trend following, the list goes on. I was eager to try them all, thinking that the more strategies I knew, the more money I would make. But this scattergun approach led to confusion and inconsistent results. Each strategy required its own unique set of rules, conditions, and mindset, and I was spreading myself too thin. The turning point came when I decided to master just one strategy. I chose a simple trend-following method that made sense to me and matched my risk tolerance. I studied it in depth, understanding not just how it worked, but why it worked. I learned to identify the right market conditions for this strategy and practiced it until I could execute it almost instinctively. By focusing on one strategy, I began to see patterns in the market that I hadn't noticed before. I was no longer reacting to every price move, but waiting for the specific conditions that fit my strategy. This approach taught me patience and discipline, key ingredients for success in trading. Once I mastered this strategy, I had the confidence to explore others. But I always remembered the importance of depth over breadth. As Warren Buffett famously said, diversification is a protection against ignorance. It makes little sense if you know what you are doing. 2. Keep your emotions in check. Emotions are a trader's worst enemy. I can't count how many times fear and greed clouded my judgment. After a string of losses, I would become overly cautious, missing out on good trades because I was afraid of losing more money. On the flip side, after a few wins, I feel invincible and take on excessive risk, only to see my gains vanish in a single bad trade. One of the most valuable lessons I learned was to treat each trade as a separate event, unrelated to the one before it or the one that would come after. The market doesn't care about my previous losses or wins. What mattered was how I executed my plan in the present moment. I had to learn to approach trading with a clear, rational mind, sticking to my strategy regardless of my emotional state. One technique that helped me was visualizing my emotions as waves on the ocean. When a big wave of fear or greed would swell up, I'd remind myself that it's just a wave, it will pass. My job was not to get swept away, but to stay anchored to my trading plan. Over time, I became better at recognizing when emotions were influencing my decisions. I set rules for myself, like taking a break after a big win or loss, to give my mind time to reset. 3. Set realistic expectations. In the early days, I was mesmerized by stories of traders turning small accounts into fortunes in a matter of weeks. I wanted that success for myself and set ambitious, often unrealistic goals. I expected to double my account every month and become financially independent in no time. But the reality of trading quickly brought me back down to earth. Trading is not a get-rich-quick scheme. It requires time, effort, and a lot of learning. By setting realistic expectations, I was able to shift my focus from trying to make huge profits quickly to building a solid foundation for long-term success. Instead of aiming for high percentage gains every day, I started focusing on small, consistent profits that compounded over time. This approach made trading much more manageable. It reduced the pressure I put on myself and allowed me to approach each trade with a calm, focused mind. Consistency became my new benchmark for success. Even the legendary trader Jesse Livermore said, after spending many years in Wall Street and after making and losing millions of dollars, "I want to tell you this, it never was my thinking that made the big money for me. It always was my sitting." Got that? My sitting tight? Patience and realistic expectations go hand in hand in trading. 4. Use risk management wisely. Risk management isn't just about setting stop-loss orders. It's an entire philosophy that underpins every aspect of trading. I used to think of risk management as something I could adjust on the fly. If a trade was going well, I might remove the stop-loss altogether, thinking I was riding a winning streak. If it was going poorly, I'd move my stop-loss further away, hoping the market would turn around. This erratic approach was a recipe for disaster. I learned that risk management is about consistency and discipline. Before entering any trade, I determined how much of my capital I was willing to risk, typically no more than 1 to 2% per trade. This rule became non-negotiable. It took the guesswork out of trading and ensured that even if I hit a losing streak, my account wouldn't be wiped out. It's not about how much you can make. It's about how much you can afford to lose. Proper risk management also meant understanding the concept of risk-reward ratio. I aimed for trades where the potential reward was at least twice the potential risk. This way, even if I was only right half the time, I could still be profitable. As Paul Tudor Jones put it, don't focus on making money. Focus on protecting what you have. Trading is about survival first, and only those who manage risk can stay in the game long enough to reap the rewards. 5. Maintain a trading journal. Keeping a trading journal transformed my approach to trading. In the beginning, I thought it was enough to just remember my trades mentally. But I quickly realized that memory is selective. I would remember my big wins with clarity, but conveniently forget the bad trades and the mistakes I made. Without a detailed record, I couldn't identify patterns in my behavior or learn from my experiences. My trading journal became my personal trading coach. I documented every trade, including my reasons for entering and exiting, the emotions I felt during the trade, and what I could have done differently. Reviewing my journal regularly helped me spot recurring mistakes, like holding on to losing trades for too long or jumping into trades without a clear plan. The process of writing down my thoughts also forced me to be honest with myself. It's easy to justify a bad trade in your head, but when you see it written down, the flaws become glaringly obvious. Over time, this practice helped me refine my strategy and become a more disciplined trader. As Peter Lynch said, know what you own, and know why you own it. In trading, knowing why you made a trade is just as important as the trade itself. 6. Stay informed but avoid information overload. The markets are influenced by a myriad of factors, from economic reports and central bank decisions to geopolitical events and market sentiment. At first, I thought the more information I consumed, the better trader I would be. I subscribed to countless news sources, followed every market analyst, and spent hours analyzing data. But instead of making me more confident, this information overload left me paralyzed. I was constantly second-guessing my decisions, overwhelmed by conflicting opinions and data points. I learned that successful trading isn't about knowing everything. It's about knowing what's relevant. I started focusing on high-impact news that directly affected the assets I traded. I also learned to ignore the noise, like opinions from self-proclaimed gurus or minor market events that had little long-term impact. Simplifying my information intake allowed me to make more confident and quicker decisions. Staying informed is crucial, but there is a fine line between being informed and being overloaded. I now dedicate specific times for market analysis and news consumption, ensuring that it doesn't interfere with my trading. As Mark Douglas, author of Trading in the Zone, wisely noted, the best traders aren't afraid. They aren't scared. They have simply learned to tune out the noise and follow their plan. 7. Accept losses as part of the game. If there's one universal truth in trading, it's this: you will face losses. In my early days, I was so focused on winning that I saw every loss as a failure. I would beat myself up over losing trades, analyzing every detail to see where I went wrong. But sometimes the market simply didn't move as I had anticipated, and there was nothing I could have done differently. The market is inherently unpredictable, and losses are part of the process. Over time, I realized that accepting losses was crucial for my mental well-being and my trading success. Instead of viewing them as failures, I started seeing losses as a business expense, like the cost of goods sold in a retail business. The key was to keep those expenses manageable. By setting stop-loss orders and adhering to my risk management rules, I learned to control the size of my losses. This approach allowed me to stay focused on the bigger picture, rather than getting bogged down by individual trades. One of the most profound lessons I learned was from a quote by Ed Seykota, a famous commodities trader. Win or lose, everybody gets what they want out of the market. Some people seem to like to lose, so they win by losing money. This resonated with me. It reminded me that the market reflects my mindset. If I was afraid of losses, I would make decisions that led to more losses. By accepting them as part of the game, I could approach trading more objectively and strategically. 8. Focus on a few assets. The allure of trading multiple assets is strong. With countless stocks, forex pairs, and commodities to choose from, it can feel like a buffet where every item looks tempting. In my early trading days, I fell into this trap. I would scan through dozens of charts every day, trying to find the next big opportunity. But instead of improving my win rate, this approach made me a jack of all trades, master of none. The breakthrough came when I decided to narrow my focus to just a few assets. I chose pre-forex pairs, USD/EUR, GBP/EUR, and EUR/JPY, that I could study in depth. I devoted my time to understanding how they moved in different market conditions, how they reacted to news, and even how they behaved during different times of the day. By narrowing my focus, I could identify patterns and tendencies that would have been impossible to notice if I were juggling a dozen assets at once. It felt like I was developing a relationship with each asset. Just like friends, each pair had its own personality. USD/EUR was relatively stable, offering predictable movements during specific hours. GBP/EUR, on the other hand, had a bit more of a wild side, especially around economic announcements. EUR/JPY was somewhere in the middle, with its own set of quirks. This in-depth knowledge gave me a significant edge. I knew when to trade aggressively and when to stay on the sidelines. This focus allowed me to adapt my strategies to the unique characteristics of these assets. I knew when to expect high volatility and when the market would likely be calm. As Bruce Kobner, a legendary trader, once said, you have to be aware of what information you need and how to use it. By focusing on a few assets, I could filter out the noise and concentrate on the signals that truly mattered, ultimately improving my win rate and trading confidence. 9. Backtesting and forward testing. One of the turning points in my trading journey was learning the importance of backtesting and forward testing my strategies. In the beginning, I was quick to jump into trades based on strategies I read about online or heard from other traders. I didn't take the time to test these strategies in different market conditions. As a result, I experienced a lot of frustration and inconsistency. Backtesting involves going through historical data to see how a strategy would have performed in the past. It's like a dress rehearsal, allowing you to see if your strategy holds water before risking real money. I started backtesting my strategies on historical charts, tweaking them until I found a set of rules that worked consistently over different market conditions. This process gave me confidence that my strategy had a solid foundation. However, backtesting has its limitations. It shows how a strategy would have performed, but not how it will perform in the future. That's where forward testing comes in. I began to test my strategies in a demo account under real-time market conditions. This step was crucial. It helped me understand the emotional aspect of trading that backtesting couldn't capture. I learned how to deal with live market fluctuations, slippage, and the psychological pressure of executing a strategy in real time. This meticulous process of backtesting and forward testing transformed my trading. It turned what was once guesswork into a systematic approach. As market wizard Jack Schwager put it, a good trading system should be timeless. It should work in different markets and different time periods. By rigorously testing my strategies, I developed a method that was adaptable and robust, significantly improving my win rate. 10. Continual learning and adaptation. The market is a dynamic, ever-changing entity. What works today might not work tomorrow, and what failed yesterday could become profitable next month. This constant evolution means that traders must also evolve. Early on, I made the mistake of thinking that once I found a strategy that worked, I could sit back and watch the profits roll in. But the market quickly showed me that complacency leads to losses. I realized that successful trading is a lifelong learning process. I made it a habit to continually educate myself, whether through books, courses, or analyzing my trades. I studied market psychology, technical analysis, and even delved into areas like macroeconomics to understand the bigger picture. This ongoing education helped me stay in tune with market shifts and adapt my strategies accordingly. Being open to change is just as important as learning. I learned to let go of strategies that stopped working and embrace new ideas. This adaptability became one of my greatest strengths. It allowed me to survive periods of market turbulence when others were struggling. As George Soros,